Hello, hi everyone. I'm Colin, Portfolio Manager at IFA's Bonds Research Team. So once again, welcome to the 2024 ETF Festival. It's good to be back here and to see everyone in person. I see several familiar faces and that warms my heart as well. So before I like to start, I want to say that over the past 1 to 2 years, it has been a very pivotal period for bond markets, especially for many of you bond investors out there. So we can see that persistently high inflation as well as decade high interest rates have really taken the fixed income world by storm. So what I mean by that is that you can see that these macro changes have initially hurt bond prices, but ultimately and eventually have created a world of higher yields. So that has also transformed the fixed income universe. And in this session, let me share our views on the fixed income universe. And lastly, and more importantly, where and how investors can find attractive opportunities in this new era for bonds. So let's start off with a recap of performance for major bond markets as shown from the chart right here. You can see that it was clearly a tale of two halves in the first 5 months of 2024. So riskier high-yield bond segments have performed well, while the safer bonds, investment-grade bonds, have not performed well over the past 5 months. And there were two key drivers for this. So firstly, the spectacular rise in the longer-end Treasury yields. So the 10-year US Treasury yields has risen, in fact, from below 4% at the end of 2023 to above 4.3% recently. So this comes as markets continue to push back the timeline and the magnitude of rate cuts. And this happens because markets have seen a series of strong inflation as well as labor market data. And as a result, the rise in treasury yields has in fact weighed on bond markets' performance, especially for longer duration segments such as the investment grade bonds. So investment grade bonds on aggregate tends to have a longer duration of about 6 to 7 years on average for the index. So the second key reason here was credit spreads. So credit spreads is largely considered as a barometer of credit risk, have compressed as global macro data continue to suggest that a soft landing narrative is increasingly possible. So the compression of credit spreads have sent the prices for high-yield bonds higher, and that have offset the drag from higher treasury yields. So simply put, in the year to date, higher treasury yields and the compression of credit spreads were what led to a divergence of performance across fixed income markets. And earlier I mentioned that the fixed income universe has undergone a transformation, and we think there are no better and simpler charts than these two charts. So to show this transformation, we looked at the Fed fund rate as well as the CPI charts to show the US interest rate and inflation have indeed risen vastly and are now at levels beyond what we have seen over the past decade. So this tells us that the backdrop for bonds are now vastly different. Meanwhile, if you look around us, you can see that the behavior of global central banks have also changed as well, with more and more policy makers really warming up to the idea of holding rates for even longer. And we do think that this shift in macro landscape has definitely injected some volatility in bond markets. But more importantly, despite these winds of change, bonds remain vital to your portfolio. So over the next few slides, let me share the reasons why. So first and foremost, global bond yields have climbed drastically and are now near post-Great Financial Crisis highs. So the chart here clearly shows that yields of the major bond markets currently, which is reflected by the grey bar here, as compared to the historical average, which is the circle, and the 90th percentile, which is the diamond shape. So across bond markets, you can see that yields are not only trading above their historical average, but also near their historical highs. So visually, this is shown by the grey bar being higher than a diamond and the circle for most of the major bond markets. So with yields at such a high level, the forward return of bonds, which have improved, which means that investors like you and me can now lock in more attractive yield, clip a higher coupon, and also enjoy greater distributions further down the road. And secondly, with yields at a much higher level, there is now greater protection against potential decline in bond prices. And as we all know, bond prices move inversely with yields, so a rise in yields leads to a fall in bond price. So higher bond yields adds to total return, which provides the greater cushion we need for against potential decline in bond prices. So in short, right now, bonds not only offer higher forward return, provide greater cushion against potential price decline, and also have the benefit of steady income and diversification. So these factors alone makes bond vital to you and your portfolio. So over the next few slides, let me share what we like in the bond universe right now. So let me start off with short duration bonds, which we continue to find compelling. So first, let us take a closer look at the US inflation data. And if you dive deeper into this data, you can find that rents as well as housing prices remain sticky and have in fact seen signs of a rebound. So we find this worrying that housing indicators shown on the chart by the left have continued to look robust despite much higher mortgage rates. We think there is a risk of shelter inflation staying sticky and in fact exerting upwards pressure on US inflation, especially if housing demand continues to remain broadly robust. And apart from shelters, we think that investors should not underestimate the upside to energy inflation, which have risen in March and in fact higher than what we've seen in the previous month. So we have been highlighting this since the start of the year, that factors such as your Middle Eastern tension, your food security policies, they are all sources of price volatility when it comes to inflation. But lately, these factors have yet again caused a surge in energy inflation, and also they are continuing to pose a threat for higher inflation. And besides the risk to inflation, which I've just shared, our research team also sees risk from strong US consumer, resilient labor market, and the potential of inflation resurgence if rate cuts came early. So with all these factors exerting pressure on inflation, we do expect the Fed to hold rates steady and not cut rates in 2024. So with this belief, we do expect two things. First, for short-term yields to remain elevated, and secondly, for long-term yields to also have room to rise further if economic growth improves or if the structural inflationary pressure increases. So why do all this matters? So it matters because this backdrop is very supportive for short duration bonds. So with our expectations of no rate cuts, you can see why we think markets are aggressive in expecting rate cuts this year. So let me bring you to the start of the year. Markets were expecting the Fed fund rates to fall to 3.9%. So as illustrated by this chart here, and this was nearly 6 rate cuts factored in. So you can see this from the blue line on this chart here. However, as markets were disappointed time and time again by the strong inflationary data and the resilient labor market data, this optimistic expectation, have started to decline and started to calibrate as well. So at the moment, markets are pricing in 1 to 2 rate cuts by the end of this year. So this was illustrated by the purple line. So this is in fact a very, very huge drop as compared to what we've seen from the start of the year, from 6 to 2 cuts. So this is important as it shows that markets are starting to wake up to the idea of little to no rate cuts for this year. And without any rate cuts, we do see little upside potential for longer duration bonds for this year. But on the other hand, if interest rates stays higher for longer, short duration bonds would benefit as yield will remain supported for higher for longer as well. So right now, yields of short duration bonds are attractive not only against history, but also against longer duration bonds. So the chart on the right shows the yield of global short duration bonds, both corporate as well as government. And this is over the past 2 decades. And you can clearly see that yields have shot up after the steep rate hikes in late 2021 and have hit levels not seen since the last great financial crisis. And if you were to invest in short duration, investment grade corporate bonds right now, they might give you an average yield of 1 to 2% over the past 10 years, which is not even attractive at all, right? But right now, if you invest in that, they can offer yield of above 5%, and that is 5% yield for very safe bonds with just a few years to maturity. And on the left-hand side, you can see that the US Treasury curve is still inverted, same as a year ago. So the same thing can be seen across many Treasury curves around the world and even in Singapore as well. So what does this tell us? So this tells us that shorter duration bonds, short duration treasuries are in fact offering higher yields than their longer duration counterpart. So let me bring this back home. Right now, the 6-month Singapore T-bills is offering a yield of roughly 3.7%. And this is significantly higher than a 10-year Singapore government security, which is offering 3.3%. So this means that the investor can get almost 40 basis points of yield pickup for significantly less duration risk. And overall, my point is simple. It is that with higher risk-free rate, short duration bonds have become an attractive investment opportunity for the first time in decades. So now let me share another part of the bond universe which we like and the reasons why we are sticking with investment-grade bonds despite the rough start to the year. For a start, cost of financing or cost of borrowing for many companies have risen significantly as a result of the steep rate hikes. So this has in fact exerted a lot of financial stress on companies, so on both investment-grade and high-yield issuers. But there is a difference. We do think that the high-yield issuers are more vulnerable to higher rates as they often have weaker credit fundamentals and as well as weaker credit metrics. So while investment-grade issuers tend to be more resilient to all this financial stress, so with rates likely staying higher for longer, this will become a even greater problem for high-yield issuers. And for a start, the amount of maturing high-yield debt is expected to climb over the next 2 years. So as shown on this chart right here, you can see that a maturity wall is expected to hit as soon as 2025. And many issuers will be forced to repay principal on maturing debt, which is often a hefty sum. But at the same time, many issuers may also have the need to refinance, and they will have to do it at a much higher cost now than as compared to pre-rate hikes. And this is for the simple reason of interest rates rising significantly. So based on our estimates, issuers that refinance today are paying coupons roughly 3.5 to 4% higher than before interest rates jumped in 2021. So this puts significant stress on the company's balance sheet. And as a result, we believe that credit risk for high-yield issuers may eventually pick up while investment-grade issuers remain resilient. So this chart here tracking the trailing 12-month default rates proves our point. So the blue line right here, which represents the global high-yield issuers, shows that the trailing 12-month default rates have risen from a low of 1.9% pre-rate hike to around 5% recently. So in fact, default rates spiked just 3 to 6 months after the rates were hiked. And diving in deeper, we find that many of these high-yield issuers were in fact smaller companies in US and Europe which have experienced a larger increase in interest rates. But to be clear, we do not expect a default event moving forward. But you can see that quite clearly, higher for longer rates have exerted great financial pressure on the vulnerable parties like high-yield issuers. So from a valuation standpoint, global high-yield bonds also remain unattractive as compared to IG bonds. So to show this visually, we compare the credit spreads for the high-yield bond index to the investment-grade bond index. So as illustrated on the chart right here, you can see that the ratio of this spread to its history, which we find that the spreads for high-yield bonds have compressed so much more than the spreads for IG bonds. In other words, high-yield bonds right now are overvalued or more pricier as compared to global IG bonds. And we also looked at the yield pickup of high-yield bonds over investment-grade bonds. So today, if you were to invest in a high-yield bond index over an investment-grade bond index, you are getting an extra yield of about 4.3%. So this is much lesser than what you would tend to get across history, which is around 5.1%. So considering the potential for higher credit risks, as well as the potential for higher for longer interest rates to last, we do think that a less than average yield pickup is not attractive and investors are not sufficiently compensated for investing in the riskier high-yield bonds. And the final reason why we like IG bonds is because of its attractive yield as compared to history. And as you can see from both charts here, for IG bonds, which you can see from the left-hand side, these are mostly IG government bonds as well as IG corporate bonds on the right-hand side. You can see that spreads are near the tightest in history. So it's almost all the way to the left-hand side of the chart. And often, tight spread will mean that yields are lower, and you can see that from the shape of the chart, which is upward sloping. However, right now, at this moment, spreads are tight, but investors can get yield, they are near historical high. And we do find that appealing as well. So having shared what we like, here are the ETFs that investors can consider. So these ETFs were chosen with a primary focus on distribution yield. And due to a lower withholding tax rate, we will mostly be recommending ETFs from the London Stock Exchange. So for short duration government bonds, we do recommend the iShare US Dollar Treasury Bond 0 to 1 year ETF, as well as the Invesco US Treasury Bond 1 to 3 year ETF. So both invest in US Treasuries with very short maturity. And these two ETFs also have high distribution yields and are also AA rated on average. So the iShares ETF is similar to a money market fund and is a good instrument to in fact capture the high short-term yields with its high distribution yield of about 5%. So this is partly due to its exposure to ultra short duration bonds right now. And with the inverted treasury curve, the 3 to 4 months, 3 and 4 months US treasury bills are in fact the highest yielding treasury instruments across the curve. And also with a larger allocation to cash and ultra short duration US Treasury, this ETF also exhibits very little price volatility and is largely stable. However, on the other hand, the Invesco ETF has a slightly longer maturity of about 1.82 years at the expense of higher yield. So this ETF we think is better suited for investors who want a longer duration to play the movement in treasury yields for the potential of capital appreciation, as a higher duration generally implies larger price change when rates change. And that said, at the end of the day, we do think that with a duration of 1.8 years, this ETF will have fairly minor duration risks. So for investment-grade bonds, we recommend the iShare US Dollar Ultra Short Bond ETF and the Vanguard US Dollar Corporate Bond ETF. So both invest in US dollar IG corporate bonds across all sectors and have a high distribution yield as well as strong credit quality. But one thing to note here is that these two ETFs provide exposure to corporate bonds, which have the credit spread component, whereas the previous two ETFs that I mentioned were exposed to government bonds, and these are widely considered as risk-free investments, and as such, these two ETFs may see larger price gains or loss. And that depends on how spreads move as well. So for investors who prefer shorter duration investment grade corporate bonds, we recommend the iShare ETF, which has a duration of about 0.38 years. And for investors who want to take on more duration, and if you disagree with our rates view, for example, they can consider the Vanguard ETF, which has a duration of 6.7 years, and this is close to the actual duration of the benchmark. So to wrap things up, I will leave you with a slide which summarizes all our views on bond markets, along with the rationale and recommended product. And before I conclude, I would like to say that yes, in fact, the investment backdrop for bonds have changed, and we see 2022 and 2023 as a big reset for bond markets. But now that markets have digested the steep rate hikes and the big macro changes, we believe that the outlook for bonds have improved and may potentially turn the tide on performance moving ahead. And with that, I've come to the end of today's presentation. Thank you everybody for your time. Happy investing.